Watch this entire video from start to finish, and I guarantee you are going to become a better trader or investor. This is going to be a special video update, and I'm going to go over a lot of topics that are going to help you better navigate this market and become a much better trader overall. All right, so we're going to jump right in, and first we're looking at a chart of the S&P 500 index, and every candle on this chart represents an entire month's of price action. And we're looking back all the way into the 1920s till present day. So the first topic I want to go over is a lot of people love to use these terms perma bull and perma bear. And to begin with, I want to give you a disclaimer that I am not an investor. I am a trader by nature, and I very rarely hold any positions for more than 12 months. So that by definition means that I am a short-term outlook trader. And to be even more specific, I am mostly focused on swing trading. Even though I do day trade, that is only to take advantage of opportunities that present themselves daily. Overall, I am a swing trader that is looking to buy low and sell high. And even though that concept sounds very simple, it can be a lot more difficult in real time when you're managing risk and managing emotions. So to start with, I want to address the investors first, because investing is very simple as long as you understand what you're doing. So when we talk about the term perma bear and perma bull, there is no doubt looking at this chart of the SPX that the market is always in a longer term uptrend. The only thing you need on your side as an investor is patience, which means as long as you give it enough time, if you throw a dart anywhere on this chart and that is where you bought the SPX, given it enough time, you are profitable and you are making money. This is the easiest way to make money, is simply buy the S&P 500 index, and you can do that with the SPY ETF. You can dollar cost average in, meaning you're buying the same amount per month or the same amount per year and just letting time do the rest. There are going to be frustrating periods in the market where that investment is just chopping around or drawing down because of a bear market. But overall, if you continue to buy more and you just give it time, you are eventually going to be profitable. Investing has its own perks and its own benefits, and some of those are tax related, but we're not going to go into the details of investing today. Simply said, if you are investing, you want to buy an index that is proven to go up over time and you want to continue to accumulate. And then the rest is simply just giving it time and letting that investment grow. So that's about all we're going to say about investing today. The rest of the video is going to be focused around trading. All right, so the first thing I want to talk about with trading is that if you are currently options trading and you are not profitable, you need to stop trading options immediately. Do not continue to throw your money away in the options market, because that market is very difficult and it's priced in so the house wins. And if you are buying options, you are by definition taking a very low probability trade. Prove to yourself that you can stay profitable only trading shares. And then if you want to start trading options, you can start with very small positions and prove to yourself that you can stay profitable. If your strategy is not profitable, you need to stop doing it immediately. And with options, you can lose all of your money because options are designed to go to $0. The best part about shares is that even if you're wrong on a trade, if you bought something that is quality like the S&P 500 ETF, you can still hold that position and eventually likely make a profit, just like I talked about with investing. If you're buying options and they're going to zero, you're going to continue to lose money. So this is more of a soul searching thing where you just need to look inside and see what you're doing is not working, and understand that if it's not working, you need to stop doing it. And then one of the most important things to remember is never trade or invest with money that you need. Your entire portfolio should be play money so that if it does go to zero and you blow up your account, it does not change the course of your life. This is so important to understand, that you should only be risking what you're absolutely willing to lose. And I know for sure there are still people out there risking money that they cannot afford to lose, and you need to stop doing that. There's no such thing as getting rich quick. That is gambling. And while people do win at gambling and some people do win the lottery, they're the very small percentage, and that should not be what your strategy is based on. All right, so now let's get into the details of trading. Now that we got a lot of that out of the way, those are very important lessons that you need to understand before you ever start trading. So please make sure you understand everything that I just went over. So the most important part with trading is making sure that you are following the chart and not trying to predict something is going to happen based on an idea. It is okay to have a prediction and it's okay to have an idea, but everything needs to be confirmed with price action and the current trend of the market. The biggest mistake you're going to make as a trader, and everybody has done it and everybody is guilty of it, is getting sold on an idea, marrying that idea, and refusing to admit that idea is wrong and allowing yourself to lose money when the chart proves to you that that idea is not playing out. So the best way I can explain this is make sure you have no bias in trading and make sure that you are always willing to immediately admit your idea was wrong and immediately switch to the other side of the trade if needed. When I say things like the trend is your friend and let the price action do all the talking, that is me telling you that you need to listen to the chart and make sure you're not listening to a bias. For example, I'm currently recording this video in the year 2023, and we are currently in a bull trend coming out of a bear market, and there are still a lot of people that are calling for a stock market crash, even though we just had a bear market last year. So when I talk about no bias and I talk about following the chart, I'm going to go over very specific examples through history to help illustrate this point of why it's so important. So just very quickly, we're zoomed out on the chart and we can see that we did have periods in the market where we had decades of the market going sideways. But remember, this is a monthly chart and we're traders, so we have a very short-term outlook and we're not even concerned about what's happening in the next couple of months. We're only really concerned about what's happening today, tomorrow, or the next week or two. So when you're looking at a macro chart and you're saying something like we're in a bear market or a secular bear market, within that bear market or even within that bull market, there are going to be counter trends that could last multiple months or years that can still be very profitable in your trading. So there's a lot of macro fundamentals out there that could still end up playing out, and things like a recession could still happen. But if they don't happen immediately or they don't affect the stock market, you're still going to lose a lot of money by having that bias. So very quickly, let's just look at the 1970s and we could see that we had a giant double bottom breakout from the 1970 low and then in the 1974 low. And then we went on this very powerful bull market, which did not top until we hit 2000. 2000 to 2008 is a much more relevant bear market because it's in the rearview mirror and a lot of people remember trading those years. So let's zoom in and let's focus on this period where the market went absolutely nowhere from the high of 2000 all the way to the high that goes out to 2013. This is a very commonly used example because that is a very emotional thing to think about, that if you bought in 2000, you did not make any money until the breakout above 2013. While that could be true, that means you bought the absolute top, did no dollar cost averaging on the way down, and as an investor, you panic sold when we got back to 2013 and did not benefit from any of the bull run on the breakout from 2013 all the way to the high in 2021. Remember, I talked about investing, and that means you need to simply hold and never think about that position and let the time do all the work. But as traders, especially ones like me that don't hold for 12 months or longer, I don't care what's happening in the next decade. I care what's happening right now. So when you look at this market, specifically speaking, we had a nasty bear market from the high of 2000 down to the low in 2002. But if you look off of the low in 2002 all the way to the high in 2007, that was a 5-year bull market. Looking back at it, if you did not buy in 2002 and you did not stay bullish for the majority of that 5-year period while we were in a bull market, you would have made no money. And if you stayed bearish because of the bear market in the rearview mirror, you would have lost a lot of money trying to short this bull rally. And then likewise, when the bear market returned in 2008, if you stayed bullish the entire way down and ignored the fact that we were in a downtrend, you would have lost any money that you made during that 5-year bull market. So it's very important when you're looking at these charts to understand that when you're in the moment and you're trading day to day and month to month, you need to be objective and you need to follow what the current trend and chart are telling you. So this is just a macro level view of how emotional that time period would have been as an investor and or even a trader that's swing trading with a bias. So when we zoom out, this is a very obvious double bottom breakout once we broke the highs in 2013, and we've been in a bull market ever since. And currently speaking, we are still in a secular bull market, which I define by being above a rising 200 weekly moving average. So if I quickly throw on the moving average that I'm talking about, you can see that price did bounce off of that level and it's still a positive slope and price action is currently holding above that level. So we are going to call this a secular bull market. So just looking at market structure, ever since we had that double bottom breakout, we have been back into a secular bull market. And even though there have been bear markets within the secular bull market, we have never officially broken down below this critical moving average. So we can confidently and objectively say this is still a secular bull market. Does that mean that we'll never go lower and we won't have months or weeks that we head lower during the secular bull market? Of course not, and we just had a bear market last year. So objectively speaking, as traders, we don't really care about the macro view. We need to focus on what is currently happening now. So what I want you to understand from the macro chart is you need to understand your timeline. If you're an investor, you have a long period of time you're holding those positions. And if you're swing trading, you need to identify how long you're willing to swing for. None of this applies to day trading because day trading is a completely different animal, and your strategy should really come down to what works for you and what allows you to remain profitable. There is no one size fits all in the stock market, and there's so many different strategies that can be profitable. You need to find what works for you, what makes sense, and then hammer it down, perfect it, practice it, journal it so that you know when it's not working, and then continue to refine it. So in the current year, 2023, looking in the rearview mirror, we had a bear market in 2022, and we are still in a secular bull market. So we are not screaming the sky is falling, even though each and every day we need to look at the chart, follow the price action, and look at the current trend. So now let's jump over to the triple Qs, and now we're looking at a daily chart. And on the daily chart, it's very important to understand each and every day you need to open the chart and you need to look at what the current price action and the current trend are telling you, and you can have absolutely no bias, otherwise you will begin to lose money. It's okay to lose a trade and it's okay to be wrong, but you cannot stay wrong once you realize you are wrong. Otherwise, that is where you're going to start losing a lot of money. So just to illustrate this very quickly, I'm zoomed out on the triple Q's daily chart, and I have the anchored VWAP from the all-time high, which is the average volume weighted price, which tells us the average investor is either underwater or in the profits on their investment. All of last year, we spent a lot of time below the average weighted volume price, which told us a lot of investors were underwater on their position. And as price approached the volume weighted average, we saw a lot of people just getting out for break even, and they wanted to get off of the wild ride that was the bear market of last year. However, this year we're seeing a different behavior, and price is currently spending a lot of time above this level. On top of that, we can see the market bottomed 3 times last year and then broke above the neckline, proving this as a technical pattern that tells us the bottom is in. This is 100% objective. Anytime you get a double, triple bottom breakout, that tells you there were buyers at that level, the sellers gave up, and the buyers took over and took control of the market. When you get a pattern like this, you typically will have the full entire measured move from the neckline breakout, and we have not yet hit that price target, and we are currently going into what is considered one of the most bearish months of the year, and you're going to hear a lot of people saying sell in May and go away. While that could be true, do not forget everything I just got done telling you, which is to follow the current trend and stay objective. What that means is that you should not be getting bearish until the price action proves it, and currently the price action is still putting in higher lows and higher highs, and we just had another higher high breakout, so this is now another higher low. When you look at this trend, it is objective to say that it is trending higher. And yes, eventually it will roll over and die, and it will likely go through a full-blown correction, which could be anywhere between 10 and 15%. But there is no reason guessing when that day is going to come. Let the price action confirm it, and you're going to see the price action rolling over and starting to put in lower highs and lower lows during that correction. It is not okay to just start guessing when that day is going to come, because I guarantee you people have been shorting this market the entire way higher, and some people were likely even shorting this breakdown, because if I draw this neckline, that was a bear trap, because it did start to look like this was a false breakout for the bulls, and the bears got very confident here. And you can go look at all kinds of social media when the bears were screaming the bulls were foolish and this was the beginning of the next crash, and bears got extremely bearish on this breakdown and stayed bearish because they were unwilling to let the chart tell them they were wrong. And now they continue to say the market's going to crash the entire time the market's heading higher. This illustrates my point that you should have no bias when you're trading, because if you were not willing to let the chart tell you you were wrong, you would have had a very small loss as a bear when we broke back above that neckline, broke out above this high, and proved that we were not breaking down to lower prices. If you stayed biased and you stayed bearish, you are having a very miserable time in this market, because you are going against what the chart was telling us. The chart told us we were possibly breaking down to reduce risk, and then immediately told us it was a bear trap. We broke out above the previous high and continued the uptrend, which solidifies that this was just a higher low within a bull trend. So make sure when I say let the price action do all the talking that you understand what that means. As I said earlier, it's okay to be wrong, but it's not okay to stay wrong. So just to bring this point home, once we broke down below that neckline, there were bulls that likely sold for a loss and admitted to themselves, look, something else is happening and we're likely breaking down. However, those bulls should have been right back into the market once we realized that was a bear trap and we broke out above the neckline and continued the bull trend. And if you were a bear that stayed bearish after the breakdown, you are now losing a ton of money on the way up as we continue the bull trend. So objectively speaking, if there's anything I want you to take away from this video, it's that trading requires you to be 100% objective and to come look at the chart each and every day with an open mind and realize that anything is possible. It's okay to have ideas, it's okay to have a prediction, but it's not okay to let that prediction or idea stop you from being an objective trader. There are so many ways you can draw this chart to show that this was a bullish breakout, and one of the easiest ways to do that was just identifying that it was a giant bull flag and that we were breaking out of that bull flag to the upside. You can see right now we have that same exact condition where we had another bull flag, even though it's a smaller bull flag, and we're currently breaking out of that bull flag. With that being said, there are still so many people out there that are calling for the stock market to crash, and they are trying to scare you into believing the stock market is going to crash instead of you simply just learning how to read the chart, make your own risk management strategies based on where the chart is allowing you to manage risk from, and then just simply follow the trend. So if you are following me and you are following my analysis, we are going to be bullish as long as this trend is bullish, and this trend continues to tell us that we're in a bull trend and that we're heading higher. There will be a day, and that day could be right around the corner, where we are going to break down and start putting in lower highs and lower lows, and we are going to break down below this low, and we are going to start back into a correction or the beginning of a downtrend. It is then and only then that we're going to get bearish, and it is then and only then that we are going to start shorting this market heavily. Otherwise, we are still looking to buy the dip while we're in a bull trend. This is the definition of understanding market structure, having no bias, and letting the price action and the trend do all of the talking. So what I want you to take away from this video is I want you to understand is, are you an investor, a trader? Understand the timeline. So how many months or weeks or days are you going to hold? And if you don't know how to be profitable, the easiest way to do that is to buy the SPY ETF and continue to dollar cost average. Let time do the rest. If you're not profitable on trading and you don't know how to become profitable, you need to stop trading and you need to reevaluate your strategy and understand what you're doing wrong. I have the Stocks Channel Discord where I give you all of my intraday updates and analysis, and I have bank trade alerts where you get all of the buy and sell signals of exactly when you should be buying and selling the TQQQs and SQQQs. So if you need help, I have services that offer that help, and I do daily analysis and I talk about all of the levels you should be looking for. So hopefully this special update opened your eyes to how important it is to understand what kind of trader or investor you are and how important it is to have no bias and stay objective. I want you all to be successful, and I want you all to do well at trading or investing because it's a very profitable venture once you figure out how to do it correctly. Trading is very difficult, and that's why you need to be very objective and you need to come look at the market each and every day with an open mind, and that is exactly why we do daily stock market analysis. So just understand the bias right now is that everybody is bearish because in the rearview mirror, we just had a nasty bear market and a lot of people are not willing to look past that. If you can look past that, you can see we're currently in a bull trend and heading higher, and that is going to be the case until it's not, which means we need the price action to tell us that it's not. Right now, price action is confirming this is still the case, so we're going to remain bullish. So I know this was a long-winded special update, and it's likely not what some of you were looking for, but as I said in the beginning, if you watched the entire video, hopefully you took something away from this, and if you're still watching at this point, I would appreciate it if you would smash that like button to help other people see this video as well. If you're still needing help in this market, I have the Stocks Channel Trading Discord community where you get access to all of my intraday updates and analysis, and you can come trade with other price action traders. And I also have a trade alert service called Bank Trade Alerts that sends you all of your buy and sell alerts directly via email and text message. So thank you for watching, everybody. I hope you're crushing this market, and as always, I will see you in the next episode.